Welcome to the world of trading, where every chart tells a story. For a beginner, these charts can look like an unsolvable puzzle, endless squiggles and bars. But what if I told you there are repeating shapes, patterns, that give you clues about where price might go next? Think of them as the market's body language. They reveal the collective mood of buyers and sellers. Learning to read them is a foundational skill. It can transform guesswork into strategy. This guide cuts through the noise to introduce two reliable, beginner-friendly patterns and how to use them in a simple trading plan. Let's start decoding charts together. First up, ascending versus descending triangles. The ascending triangle. Picture a horizontal line at the top, a ceiling the price can't break. Now imagine a rising floor, higher lows on each dip. Connect them, and you get a triangle pointing up. Now the mirror, the descending triangle. A horizontal floor the price struggles to break below. Above it, a descending ceiling. Rallies hit lower highs. Put the lines together and the triangle points down. Inside, price compresses and uncertainty grows. Often you see a drop in volume as traders wait. Eventually one side wins, buyers or sellers, and the breakout happens. Breakouts often come with a surge in volume and strong directional moves. Ascending triangles lean bullish, descending triangles lean bearish. But context and psychology separate pattern spotting from effective trading. How do you find them on a live chart? It's easier than you might think if you know the clues. First, look for a double test of a similar price level. Two highs or two lows at roughly the same price, a big clue. Next, inspect the swings in between. Ascending, second low must be higher, forming sloping support. Descending, look for lower highs and a downward resistance line. That forms the downward sloping resistance. Add confirmation. Triangles forming at major support or resistance are more reliable. A triangle at a weekly resistance is stronger than one in thin recent price action. Rule: look for longs when the pattern sits on support, and shorts when it forms at resistance. That confluence filters out common traps and false breaks. Context matters. Sometimes a breakdown will fail and bounce from big support. Identifying the pattern is only half the battle. There are three common entry methods: signal candle, clean close, and retest. Method 1. Enter on the signal candle that breaks the pattern. Place the entry just above the high or below the low for shorts. Method 2. Wait for a candle that fully closes outside the triangle. This gives more confirmation of a legitimate breakout. Method 3. Wait for the pullback to retest the broken level. Enter when the retest shows rejection, pin bar, or engulfing candle. Stops and targets separate you from the herd. There is no one-size-fits-all. A 50-pip stop may suit EUR/USD daily, but not a 5-minute FTSE trade. As a guideline, aggressive entries use a stop just below the entry candle. Aim for a minimum one risk to reward. Test what works for you. Backtest and journal your trades. Adapt stops and targets to your market. See how setups play out and refine your entries and exits. Ascending and descending triangles, support and resistance, entry methods. These are building blocks. But knowledge alone doesn't make profits. Practice and demo. Paper trade and replay history. Identify dozens of patterns and tally outcomes. Not every setup will work, except losing trades. Aim for winners larger than losers over time. Focus on the clearest setups that jump off the chart. Decline low-quality trades. Discipline builds edge. Personalize the strategy to your market's time frame and risk tolerance. Create a trading plan and position sizing rules that fit you. Becoming consistent is a marathon, not a sprint. Test, iterate, and refine. Your rules become your edge. Keep practicing. Stay disciplined. Focus on high-quality setups, and you'll give yourself the best chance of hitting your goals.